Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to the final installment of our Through the Noise podcast mini-series, where we go into a bit more detail on our Q2 investment outlook titled Staying Safe. Today, we're going to focus on our sector preferences within the US, Europe, and China. And joining me today is Fook Hien, who heads our sector investment committee. So, Fook Hien, thanks for joining me. Let's jump straight in. So, obviously, I was talking with Daniel on Tuesday about our headline equity market views as we head into the second quarter, and how we have a cautious outlook on global equities, particularly in developed markets. So, how does this affect our views on equity sectors?
Yeah, thanks, Steve. So, we do have an underweight view on global equities. And a big driver for that is our view that a recession is likely in the US and Europe over the next 12 months. So, looking at US equities, where we expect some weakness ahead, our preference is for a defensive position, right? So, we see three sectors that are likely to outperform the broader market in the US, namely consumer staples, healthcare, and utilities. So with staples, it has historically delivered positive EPS growth, even in a recession. And so it is seen as a reliable outperformer heading into your cyclical slowdowns. And a healthcare sector, it also provides a defensive exposure with a reasonable valuation we see. And we think that the profit margins there are also resilient at a time when there are a lot of cost pressures through the economy. And similarly with utilities, this is a sector we just upgraded to be overweight in the US. It has a defensive exposure with earnings growth that is relatively more predictable than other parts of the economy. And it actually offers higher earnings growth now than for the broader market in the US.
Okay, so maybe are there any sectors that you would avoid at this time?
Yeah, we don't say avoid specifically with any sector because that statement is too broad, and there can be very specific opportunities with any sector. But we do have an underweight view in the US. So we just downgraded the financials and materials sectors to be underweight, which means we believe it is likely that these two sectors will underperform the broader US market over the next 6 to 12 months. And in the rationale with financials is that your lingering concerns with the regional banks, which are less regulated than the large US banks, these concerns could weigh on the broader sector. And also after the two bank failures in the US, we think that funding costs are likely to be higher there, which could squeeze the bank's profit margins. And with the underweight in materials, it is a cyclical sector that is vulnerable in a cyclical slowdown. So we see downside risk to their earnings, especially in a recession.
Well, on the recession theme, I guess you mentioned that we expect a recession in both the US and Europe. So what about sectors in Europe? What are your preferences there?
Yeah, so rather similar to the US, we are also positioning defensively in Europe. So we have just one sector we are overweight on in Europe, which is utilities. So we like the resilience with utilities at a time when growth is slowing down, and also valuation of the sector looks reasonable given the defensive exposure. And there's also one sector where we have an underweight view on, which is real estate. So the price momentum for real estate stocks in Europe has been bad, and we think it remains poor. So rising interest rates have been a headwind for the valuation of real estate companies. And we have also seen credit defaults starting in the real estate sector in Europe. So we continue to think that the sector will underperform in Europe.
Okay, let's move to China. I guess the case that we're making in China, and Daniel articulated this well, is that we're at a different stage of the economic cycle there. So I guess the sector preferences in China are slightly different in nature relative to the US and Europe. Can you take us through those?
Yeah, absolutely. You're right. We do like China equities where government policies are pro-growth, earnings growth is better, and valuations are more attractive. And so we believe investors should buy the ongoing recovery in China. And specifically, there are four sectors where we are overweight there, namely communication services, consumer discretionary, technology, and industrials. So the communication sector, it is dominated by media and entertainment companies that we believe will benefit from greater consumer spending and a recovery in advertising and policy support for internet platforms development. This policy support for the internet platforms, it also benefits the consumer discretionary sector, and the ongoing reopening and policymakers' priority in boosting domestic consumption would also benefit the discretionary sector. With technology and industrials, these two sectors' earnings growth this year are not as strong, but we think the valuation is attractive, as well as with policy support from the government, it can help these two sectors to outperform. So with technology, we see the government's goal of a digital transformation and accelerating it. We see this as a tailwind for the sector, while valuation remains attractive. So the tech hardware volume, the growth could resume in the second half of the year, and the ongoing localization of your semiconductor businesses, that also offers support. And with industrials, the support there is from policymakers calling for technological upgrade of your key manufacturing sectors and an expansion of domestic production capacity. And a segment of industrials is also transportation, and a recovery we see in the express delivery and transportation volumes would also benefit the industrial sector.
Okay, well, unfortunately, that's all we've got time for today. Thanks, Fook Hien, for your insights. And this concludes our Through the Noise mini-series on the Q2 investment outlook. I hope you found it useful. If you have any questions, please reach out to your relationship manager or go to Standard Chartered Wealth Insights on either LinkedIn or Facebook. In the meantime, I look forward to catching up with you all again soon, and happy investing.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.